Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Place, and today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used for this video are for demonstration purposes only and should not be considered a recommendation by Options Trade or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we'll be kicking off with the major equity indices, highlighting some key levels, and taking a look at the recent price action. From there, moving on to fixed income and commodities, we'll also take a look at the sector rotational model, highlighting which sectors are outperforming and which sectors are underperforming the overall market. We'll take a look at a few subsectors of interest that I have for you today, and we will end today's session with some bullish and bearish market observations. So before looking at the major equity indices, always important to look at what's happening with Fed rate hike probabilities, especially now, with more traction really being gained with regards to the importance of the rate hikes. So we do have the next meeting on the 22nd of March. The current target rate is 450 to 475. And right now, Fed futures are pricing in roughly 70% probability of a 25-point move, which will take the current target rate to 475 to 500. And Fed futures are pricing in a 30% probability of a 50-point move, taking the target rate to 500 to 525. So the majority still lies with a 25-point move. That being said, the reason why this is quite interesting is the fact that, a few weeks ago, actually 1 month ago, the probability of a 25-point move was around 99%, actually, or very close to 100%. And since then, it has declined during this recent market downturn that we've experienced to 70%. I do still think we most likely will get a 25-point move, but highly dependent on the economic data that comes out. We have a very big week for the macroeconomic or / fundamental side of things. We have Jerome Powell speaking in a few minutes, I think, at 8:50. And we also have jobs data on Friday, as well as inflation numbers next week. So huge economic indicators, and that is likely going to dictate price action over the next month, along with whatever the Fed's saying on the 22nd of March. And right now, yes, inflation is coming in a little bit harder than expected, and yes, markets are pricing in a slightly more hawkish Fed, but that can change very quickly depending on the data that we get, and also depending on what Jerome Powell says regarding inflation and regarding interest rates today. So taking a look here at the S&P 500, and overall, my outlook here is actually quite neutral. Over the next few days, I do expect very tricky trading conditions. The reason being is that markets are clearly waiting for not only the speech data today, but inflation data and jobs data, as well as eventually later this month, the interest rate decision. But the short-term jobs data and inflation data and speech from Jerome Powell is going to most likely result in somewhat choppy market conditions, in my opinion. And it does also speak to the fact that price action has been quite confusing of the S&P 500 on the daily time frame. So if we take a look, recently, the recent price action, we saw a strong rally to the 420 level, which is also the 23.6 pip area. And price rejected that, was consolidating near it, but we saw on the weekly candle multiple rejections, and eventually broke down, breaking below its 21 and 55-day exponential moving averages. But in the last 3 sessions, moved higher with a lot of momentum. Now, the reason this was confusing was because there was no real fundamental catalyst behind this move. In fact, if we had seen maybe the probability of a 25-point hike increase over 50-point hike, then that would have made some sense. But we didn't quite see that. It just seemed like there was, the well of sellers had dried up. So this move, doesn't necessarily mean we're going to see a breakout. I think To see a breakout above 420, we need a fundamental catalyst, and that fundamental catalyst is most likely going to be coming in the form of either a um, very cold jobs report. Remember, bad news is good news when it comes to jobs. We know the labor market is a high contributor of inflation, and because of that, we want lower jobs numbers to curb down inflation. That's what the Fed is looking at. And if we do get those lower numbers, which we didn't get last month, in fact, it came up 3 times higher than expected, I could see potentially a breakout above that 420 area. But for now, until we get that, or better inflation numbers, or severely more dovish Fed than expected, I don't expect to see a breakout there. I think this move higher, if anything, may continue a little bit higher as well in the coming days, but does set up for good risk to reward bearish opportunities. So for now, my sentiment is a little bit more neutral. If anything, I'll be sitting a bit more on my hands this week. Let's wait and see what happens with the speech data, wait and see what happens with inflation data and jobs data. Moving on to the NASDAQ 100, looking at the QQQ ETF. And what we're seeing here is, again, a pop-up back to the 300 area. And between 300 and 315 is really that resistance levels. That is the key resistance level that I am looking at. On the weekly time frame, we can see it did act as a major area of support and resistance in the past. And right now, price has tried to move higher, move above that level. Wasn't quite sustainable, moved lower, but once again, it's retesting. We did see a very strong rejection intraday yesterday, just from 305 or so to 304. And again, it does look like the S&P does look like it's going to be a risk reward bearish entry point soon, depending on how this economic data moves. But overall, price action in equities has been somewhat ambiguous. Very difficult to tell whether we're bullish or bearish in the very short term based on price action, because yes, we've had a lot of momentum, but already a rejection in the previous session. And we do have very important economic events coming up. In terms of key areas of support here for the NASDAQ 100, we have the 290 level. So should we see price actually decline over the next few days? Our futures are a little bit higher this morning, but should we see price decline over the next few days? We could be revisiting 290, which is clearly a support level based on the last few days of price action. And if it breaks below 290, we have 280 as well. It has acted as previous support. I'm not worst case, between 270 and 260 is another major key area of support. I don't believe price will actually break below that level for it. All right, taking a look at IWM, which is a Russell 2000 ETF. So right now we are looking at small caps. And small caps have, I spoke about the recent outperformance against the large cap names. However, more recently, that hasn't really been the case. We've seen a little bit of underperformance over the last 3 or 4 sessions. Nothing to be too alarmed of or anything, but just quite interesting to note. That being said, small caps still above the key 188 level. This is a very strong level. It's a 38.2 fib level. I apologize, I may have cropped that out in my screenshot, but it's a 38.2 fib level on the weekly time frame. So it's a very strong area of previous resistance and also previous support. So that is the key level that I'll be looking at. And if we see a break and consecutive closes below 188, that could see price actually decline a little bit further and eventually fall back into this range between 188 and 170, which is the 61.8 level. So right now, like small caps are respecting their key Fibonacci levels. So the fact that price is above 188 and is staying above the 50%, sorry, the 38.2 fib level, that is very encouraging for potentially a continuation high for small caps and a long-awaited recovery after 2 years of pretty poor performance. All right, moving on to TLT, which is the Treasury Bond ETF. Now, what we saw here in the recent few weeks was obviously 108 acting as a key area of resistance. This is a level that we've spoken about for quite some time, the last few months really. And this was because it was a previous swing low before the bottom. And we saw price rally to that level, the previous area of support turned resistance, and it was a very strong area of resistance. price was unable to break above it on multiple occasions, eventually broke down on the news of a more hawkish Fed and maybe a shift in sentiment in the markets, and is now finding support at 100. So this was the key level that we were looking at last week, this $100 key level. And what we saw was, yes, there was initially a bounce higher, but not enough momentum to indicate a continuation higher back to 108, which is why I was not bullish on TLT, despite the fact that it looks like a tempting risk reward a good risk reward bullish entry point. And we can see that happening this week. Lack of momentum, price rejecting that 102 level, rejecting its 21-day exponential moving average, and really over the very short term, looking quite neutral. If we do get a breakdown below 100, we could see a revisit of that 92.50 level. That is the next key area of support. And should we get a reversal higher here, 108 would be the key area of resistance, which, if anything, would provide another nice risk to reward bearish entry point, especially now that we know where interest rates are heading. Markets are pricing in around 5.5%. Fed was saying 5.25%, and there's some evidence the markets might actually be correct on this one, and the Fed might be backtracking and saying that 5.5% is the target rate that is needed in the future. All right, the US dollar. So US dollar actually did reach our 105.50 price target that we set a few weeks ago, but since then it has been consolidating, not a reversal like we saw in the previous time we tested 105.50, but consolidating above its 21 and 55-day exponential moving averages. So very similar pattern to what we saw a few weeks ago, where we saw a strong move higher, followed by consolidation, followed by another move higher to reach a 105.50 level. It looks like we are once again entering that consolidation phase, and that could eventually lead to a potential breakout above 105.50, with the next key area being at 107.50. So again, US dollar very much dependent on where the market sees interest rates will go. Obviously, a more hawkish Fed would indicate more strength or more dollar strength relative to other currencies, and a more dovish Fed would indicate weaker dollar strength towards for the dollar and against the other currencies in the basket. So for now, 105.50 and just consolidation below that, clearly not a reversal. Does look primed for a retest of 105.50 and a potential trade-off opportunity. And moving on to gold, remember gold moves inversely with the US dollar. So what we're seeing here was essentially that move higher after price reached the 167 area. Strong area of support between 167 and 171. And it did break out above 171, but not really showing a lot of momentum here in the last session to continue the breakout, looking like it's an intraday retest. I think today's price action will be quite interesting to see whether gold can actually stay above 171 or break back below. If it stays above 171, we could see a grind higher, but again, very much dependent on what the US dollar does. If the US dollar continues to find support, I do think there'll be a lack of momentum here for gold for that push higher, and we may see a more neutral environment for gold, potentially a retest back to 167. I do expect gold prices to remain elevated for the simple fact that gold is a safe haven asset, and we have recessionary fears. There's a lot of uncertainty in markets right now. There's even geopolitical tension between the US and China. And for that reason, I don't expect a strong decline in gold. I do expect the price to remain somewhat elevated. And if you look at the weekly time frame, we can actually see a very large bullish engulfing candle there from the previous bearish candle. So that would normally indicate a continuation higher, but we haven't quite seen that just yet this week. All right, taking a look at oil, and once again, oil respecting the key areas of resistance and support between 81 and 70. This trading range is something we've spoken about for months, and what we did see price managed to rally all the way back to this 81 level. A bit of an intraday rejection so far this morning. Let's see if that actually holds up, and if it does, if resistance does hold up, that will provide an excellent risk to reward bearish opportunity here. So you'd be looking at energy names, very short-term exposure, 1 week, 2 weeks max, or that move lower, because those energy names will have a high exposure to oil prices. But like I said before, the supply and demand dynamics of oil are very much balanced. The demand side, we have China reopening, that would naturally lead to higher oil prices, but we also have recessionary fears that leads to lower oil prices. And I think markets have now priced it in quite well, and we would need a strong fundamental catalyst to either get a breakdown below 70 or break out above that 81 level. So for now, price trapped between 81 and 70, so it means very short-term bullish or bearish plays based playing on these areas of resistance and support. Okay, taking a look at sector rotation, we now have 4 sectors in the improving and leading category, and we have 7 in the lagging and weakening category. So quite similar to what we saw last week, pretty much a continuation of what we saw last week, with communications entering the leading category, continuing to find some very good relative momentum and relative strength against the broader market. And we also have technology finding that momentum over the last week or so to rotate back into its leading category with some good relative strength against the overall market. Remember, the technology sector is the biggest sector that contributes to 28% of the S&P's total weighting, and therefore it is one of those sectors. It is the sector that can essentially drag the entire market up, or the major indices higher, like the S&P and the Nasdaq, even if we see underperformance from other sectors. We saw that for 2 years or 1.5 years during the pandemic recovery period. Taking a look at discretionary, still managing to find some good momentum, but pretty much still in the middle of this improving category. And real estate losing out on some momentum, but on the brink of moving into that leading category. All 3 defensive sectors in the lagging category. Again, I still find that quite surprising given the amount of uncertainty in markets. But let's see how long this does last for. I do think we may need more confirmation from the macro side. And if there's more bad news, I wouldn't be surprised to see stronger rotation back into these defensive sectors. And as for the weakening category, we still have energy continuing to lose out on some relative strength, as well as industrials, materials, and financials. Okay. All right, moving on to IBB, which is the biotechnology ETF. So looking at our subsectors of interest, I don't know, IBB has been a name that we've been looking at for quite some time, but it's also been quite an interesting name when you look at the price action. We highlighted 138 as a key resistance level a few weeks back, and price has respected that resistance level quite nicely, but then moved lower, followed by a short-term retracement higher, followed by another move lower, and actually breaking below 128 during that time, managing to break above it, but already running into resistance at that 21-day exponential moving average. So bearish structure on the daily time frame over the last 3 or 4 weeks still remains intact, and I do expect to see a continuation and potentially another bearish leg for IBB, which could see price reach 122. So this was a trade idea that has worked very well in our favor. Also, if you look at short-term momentum, which is the red line, sorry, my mouse is being weird, which is the red line, it did reach an overbought condition 2 sessions ago and immediately rejected from there. So short-term momentum overbought during a bearish leg provides an ideal bearish entry point. And the next key area of support other than 128 would be at around 122. Taking a look at XHB, which is a home builder ETF, originally a bullish idea, and I had my doubts with XHB, especially after broke below the 21-day exponential moving average, but finding support at the 55-day exponential moving average now, and actually breaking back above the 21-day exponential moving average. That being said, we saw JP Morgan, I believe, yesterday downgrade a few home builder names. So sentiment is shifting for home builders, and the momentum that we've seen in the last few months might disappear. So for that reason, I would say I'm no longer bullish here with home builders. Even though price did break above the 21-day exponential moving average, the fact that there was a double downgrade And, you know, a very strong bearish candle, almost not an engulfing candle, but almost an engulfing candle, does lead me to believe that maybe this is an idea that just won't come to fruition. And unless the overall market continues to improve. But for now, I would probably say, you know, builders was just a name that didn't work out for us, unfortunately. Okay, taking a look at DRIV, the Autonomous Electric Vehicle ETF. So a similar situation to home builders, but no downgrade there. And therefore, I would say I'm still somewhat bullish here. And after price past support at 23 and its 55-day exponential moving average, we saw a lot of momentum over the last couple of days, followed by some bearish price action, potentially just an intraday pullback, or we could see a continuation higher. We spoke about Tesla last week, providing a lot of support here for this ETF due to its weighting and the fact that Tesla is performing very well relative to the overall market. So we could still continue to see continuation higher for DRIV. That being said, something that would invalidate this analysis would be this very short-term bearish trend line. We saw price react to yesterday. I would like to see a breakout today or tomorrow of that trend line to stay in this trade or to stay with this idea. Because if we don't see that, that means we could be in store for potentially another retest of 23 or even a leg lower. But for now, I still think that there's enough momentum over the last couple of days to see DRIV potentially break above this minor trend line. Roku. So Roku was a bullish, well, it wasn't a bullish or bearish play. It was bullish last week, but my overall thesis here for Roku is to play the range, somewhat similar to oil, the oil chart that we saw earlier, where we have a clear area of support at 60 and a next key area of resistance at around 90. Oh, sorry, at around 80. What we saw was a very strong move higher, followed by a pullback to its exponential moving averages, followed by another move higher, and a strong rejection of that 75 to 80 area, followed by a retest, previous area of resistance, turning support, and so far has been confirming a support, but the one thing I will say is price is struggling to find the momentum. So Roku would be a good example of potentially a credit spread trade where you still profit from the neutral or slightly bullish move in the market or in the stock, and you don't need a large moving in favor. Because right now, Roku does not have that momentum, but it is still staying above the $60 level, which is a strong area of support. So our bullish thesis still remains intact. Okay, moving on to IBM. So IBM longer-term bearish play here for us has worked out beautifully, continuing to work out beautifully. We had a strong move lower, followed by a retracement higher, followed by another strong move lower, breaking below key levels in the process, and 137 previous support being broken, now providing resistance at 137, and followed by more recently a strong move lower to 128, and price now starting to retrace higher. We could see a retracement higher to about 133, 134, the previous swing low, before another nice risk to reward bearish entry point here for IBM and potentially another leg lower. On the weekly time frame, though, you can see the price has been stuck between around 115 or so and 150. So over the longer term, this is a bearish play, as I do expect price to respect this trading range and to continue lower, potentially back to 120 or 115 or so. But for now, on a daily time frame, it's more about time. We're looking at it more from a timing perspective, and I want to see maybe a few more days of retracement higher before an ideal risk reward bearish opportunity emerges. And finally, taking a look at Apple, so slightly new ideas for today. I know I may have mentioned this a few weeks ago, that we saw this rejection at around 155, 156, and we saw a nice bearish move that worked in our favor. What we've seen here is another move higher, back to the 155, 156 area. Strong rejection yesterday. Yes, price set to open a little bit higher this morning, but the risk to reward here does point nicely to the downside. And you know, if price breaks above 155 or 156, this is a trade that we can very quickly cut our losses on and move for a very minimal amount and move on to the next one. So a very good risk to reward bearish entry point, strong rejection there, at a clear area of resistance does provide some confirmation of a move lower. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week ahead.